Let's go ahead and get started. If everybody can hear me, if you can't, go ahead and send a message, but we're going to kick off. Thank you guys for joining us today at 10 Capital. Wanted to go through and answer any questions you have, and we had several questions come in that we'll go over first. And then as you have questions, go ahead and add them into the chat box and we'll answer those as we go through. So let's go ahead and kick off. So my name is Hall Martin. I'm with 10 Capital. I want to thank you for joining us for our Ask Me Anything session. You can submit your questions in the chat box below, and please do so at any time, and then we'll answer those. What we're going to talk about today first is break the raise into milestones. In raising funding, it's best to break the raise into smaller steps rather than raising the entire funding in one go. I often talk to companies who are starting off at the seed level, and for the life of the business, they want to raise $3-5 million. And when I ask how much you're raising, they say $3 million. And in most cases, they're thinking that's the life of the business, but in some cases, that's just the first round. But in general, what you'll find is when you're going out to raise funding, the very first round is $250K, and that's family and friends. And you're just standing up the business, getting the website up, getting some basic legal work done, IP, as well as patents filed, et cetera, and you're just getting all the elements in place to start your business. Then when you have something you're building as far as an initial product and have MVP, you go out and raise a $500K round. That's your seed round. Some call it a pre-seed, but it's the early stage bunny that will go and actually build out that product and will actually take care of putting that up. And then if you're in a position to go raise a Series A, you do so, but most companies are not. They come back to me and they're raising another $500K on what's called a Seed Plus round, which is just another $500K at the same terms as the last round. But to get the valuation you want, you have to go through the process of actually raising additional money to put more product in place, put more revenue in place, get the team in a better spot. And then you can go after your Series A, which is usually a raise of $1 to $3 million. And most people have a target valuation in mind, target investor, and the investor is telling you you have to be at this level before we'll put the lead money in. And so that's what you're doing, is trying to get to a place where you can qualify for that money. The key with raising money is, and sometimes people will say, I want to raise $5 million in one go, is that if you raise too much at the start of the business, you'll end up giving away too much equity. You only want to raise a certain amount at every round so that you don't give up too much equity. And as you achieve more product, more sales, more traction, you can raise the valuation and not give up so much. So in that $3 million example I gave a moment ago, you would raise $250, $500K in the early days, but the majority of that money, $2.5 million, you would raise later when your valuation is much higher. At the very beginning, your valuation is as low as it will ever be, and so you want to raise as little money on that as you have to. As you get a higher valuation, you can raise bigger dollars without giving away too much equity. So it's best to tranche out the raise and increase the valuation at each step. So at that point, the first question up is from Greg Silverman. Let me check to see what questions we have here so far. See if anybody else has come on with additional things that we need to talk about. And looks like we don't have any other questions, so let's get into the first one. So Greg is talking about, I like the topic of breaking milestones into, breaking things into milestones. We're negotiating a term sheet for a $3 million raise where we ask for $15 million pre-money, and our ARR is $2.4 million. That's annual recurring revenue. We have raised $4.6 million in equity so far. We have a $600K in a line of credit. Our issue is that our angel investors want our next round to be $3 million, leading to a $7 million round. But they think we should take a lower valuation than $15 million because they don't want us to get slammed if we do not grow into the ARR needed for the next round. So the question is, should we break the financing into two rounds? And the answer is yes. My response is always break the funding down into smaller steps so you can raise the valuation if you hit the goal and go and stair step up to add more funding to it. The biggest problem is not that you had too many rounds of funding, but that you overpriced a previous round. And as we come out of this 10-year bull market with highly inflated prices and move into the recession, led by COVID-19 and the pandemic, valuations will go down. If you look at 2008, the valuations went down by 20% afterwards. And the early stage seed and Series A didn't get impacted too much, but as you get into this late stage Series A and B, you will start to see some compression on the valuation. So you won't be able to command as high a valuation as you originally thought because the economics have changed. The investors took a 20% haircut in the stock market. We'll see how much they end up with at the end of this round, but they will expect the startups to be commensurate with that. They're looking for a better price because their money is not worth as much as it used to be. And as always, it's a negotiation at the end. So my recommendation is that you stay at a smaller raise. $3 million is what I would raise at this point. You want to give yourselves 18 to 24 months runway. So whatever $3 million buys you, you have to cut your expenses to make that last for 18 to 24 months at minimum in order to get ready for growing your business. I would not hold out for a $10 million round. I think that's going to be too much. You'll be spending too much time raising funding. You'll be spending, you won't get the valuations you would like to get for that at this stage. So I would go for the smaller raise, the reduced amount of expenses to get there, and then go forward. Even if you're in a strong market segment with strong comps and so forth, I think you'll find that it's still going to be hard to see those continue in the next stage here with COVID-19. Again, I would just reset everything down by 20% in order to know what you might get on the next round as well. The exception to that is if your product or service is finding unusual traction in the COVID-19 world. If you're finding tremendous growth or a new growth segment, then it's a different game at that point, and there's probably no comps out there for it yet. Zoom is an example of this. Slack is an example of this, where they're seeing tremendous growth in their business, and so they will bid up the price of the value of the shares. But it's not clear how much they will bid it up at this point for what you're doing. So that's my current answer. If you have any thoughts, give me a shout out on the chat there, and we'll see what we can do on that as well. Let me see what the question was. Okay, great. So if you're not a Zoom or a Slack, then you're probably not going to get an overinflated valuation. You're probably going to get a regular evaluation like everyone else. And so what valuation you thought you would get, go down by 20%, and then you'll be in a better spot to know how much you're going to do it. So I would go with the smaller raise. The question I always ask myself when someone raises funding is not, can you raise this round? In most cases, people are halfway through, they've got a valuation, and they probably will. The question is, after this, can you raise the next round? In other words, will the money I'm getting now let me grow to a point that I can ask for a higher valuation on the next round? And the answer to that question is often no. I can raise this round, but I really can't raise the next round. And that's where companies go out the door or go under, is because they simply couldn't keep raising money because the valuations in the early stage got overinflated. So let's see. So what happens if you overprice a round and you get to the next round? What you have to do is cut expenses and try to grow revenue to get your value up, and it'll be a while before you get to that next valuation step. And if you can get at least to where you were, say last round was 5 and you were expecting to go to 10, you find you can't go to 10. Well, what you have to do is get to at least 5. You can't go up, you can't go below 5 because you're in for a down round, and that is catastrophic to the investors. If you can come in at 5, then you're going to be okay with investors, not great, but okay, but you're going to live another day. And so you have to reduce burn. You have to get the valuation, get the company's metrics up for revenue, et cetera, so you can at least come in for another 5. And we see that a lot, people coming in with another round, but is at the exact same terms as the last round, which is a good place to be at this point. So that's always one of the questions to ask yourself is, what impact does the coronavirus economy have on your business? Are you going to find a new revenue stream there? Are you going to find a new growth story there? And if you have that, well, then I would certainly make hay with that at this point with investors, because investors are now looking very hard at this COVID-19 market and finding that there are some trends in play before it started. We were moving to telehealth, we were moving to distance learning for education, we were moving to remote work at a pace, and now those paces are accelerating dramatically. And those who are in those spots are picking up quite a bit of market share and revenue, and investors are looking for those deals because they know at the end of COVID-19, those trends will continue. And if they continue, then you're going to be even stronger on the other side. So that's the answer to that question is, or that's a question for you to answer is, what is the coronavirus economy going to have on your business? So the next question comes from David. When do you expect the market to hit bottom? I'm expecting it to hit bottom in about 60 days. I think it's still got ways to go down. Every day there's a new discovery, and there's so much going on that it will take a while to discover everything. So I think we're on our way down for another leg. And as the COVID-19 hits and comes full blown, I think it will go down further. I'm not a market specialist, but I've just seen these before where it goes down and you think it's going to bounce back and then it keeps going down. Well, that just means we're just discovering everything that's really going on. And I think when this market will be continuing to discover a lot of things for the next 60 days. And so come June, I think we'll start to see a bottom, and then we'll know what the new reality is going to be, and then we'll rebuild from there. So that's my answer to that question. The next question up is from Jai Shin. I'm curious, let's imagine that all things become normalized by end of April, early May. I think Jai is a little optimistic, but it'd be great if that happened. I'd like to get a survey result from the VCs. Would you plan to write some checks during summertime, June to August, to recuperate deal flow from first and second quarters, or would you rather wait for September to reinitiate everything? I'm wondering whether I should restart tapping on VCs full-time fundraising as soon as the crisis stabilizes, we get out of the shelter and work from home period is over, or just focus on building product and clients during summertime and restart fundraising from September. And my answer to that is, for venture capital who have already raised funding, they have money in the bank. Money's in the bank today, and they are continuing business as normal. They have to deploy it. They have to get out there and get the deals done on a certain time schedule, and so they're continuing forward. And they will be looking for a little better evaluation than before, but fundamentally they're continuing on. My recommendation is, if you're looking for VC funding, you continue to go raise with VCs, because it is a time process. We find it takes about a month to go make the connections, get the original introductions. It takes another month to build a relationship and go through and really understand what's going on, and then another month to go through their diligence process. Of course, you always ask what their process is, and you provide those documents. And you should come prepared for a diligence process, have the basic documents ready to go. But it's a 2 or 3 month process anyway, and I think it's a great opportunity to go build those relationships and educate them about your deal. You may not be raising funding very hard, and I wouldn't put any close timelines on it, but I would use this time. I once had an entrepreneur come to me and say, I'm not raising money now, but in 6 months I will be. Can I keep you informed of our progress? And I thought that was a very clever way of doing it. You have to get 6 to 7 touches in with the investor, whether it be an angel, a VC, or a family office. And what he was doing was coming in and putting me on notice that there will be a fundraise coming up, and then every month he sent me a short update about what was going on. I was able to track through what he was doing, how what progress he made, how he was doing it. It wasn't always smooth and steady, but every month the email showed up and it reminded me that, yeah, he was there still raising. And then in 6 months, when the campaign started, he was able to close it more quickly because he had already done all of the touch points, made all the connections, and had educated all of the investors about the deal. And I was quite impressed by that. So I thought that's a good idea. When you're raising funding, three to 6 months in front of launching it, start canvassing the investors, saying hello. And it's somewhat disarming to go to an investor and say, well, we're not raising money now, but we will be later, because that takes the pressure off. Nobody's going to be asking me for money right now. Nobody's asking me to make a decision or to do something today or this week. That comes 6 months from now. And so at my leisure, I get to learn about the deal and get to meet the team and understand better. And so it's a great way to get out there and start raising funding without really raising funding, and to build that list of people that know what you're doing and what you're all about. So there's that. There's the answer to that question as well. Any other questions out there? Let's see who else might be on the chat room itself. So if you have any questions, go ahead and plug them in. One question I get asked a lot is, what is the impact of COVID-19 on investing in general? And what I found is, going through the 2008 financial crisis, is that with seed and Series A, there's little to no change. The money people had, like VCs, are already raised and ready to deploy. Some angels are going to be looking at the stock market to go up and down, but when that settles, they're going to go back to doing the deal flow they were always doing, and so there's not much there. When you get to Series B and C and later stage venture capital, you'll find that there'll be substantial cutting back. It'll be down by 20 to 50% as far as how much money goes into it, because now you're not talking about 500K, you're talking about 30, 40, $50 million in some cases. And in some cases that money will not be there anymore. It will have been cut back for other reasons. And so the next thing you'll find is that valuations will go down. As we talked about earlier, they'll go down by about 20%. So whatever your expectation was before, you'll see the investors looking for you to be coming down to be a little bit more realistic. The valuations in the stock market as well as the venture capital world were quite inflated up until a few weeks ago, and as the stock market comes down, you'll see the valuations come down as well. The next thing is they'll be looking to see how well you're doing in the coronavirus economy, not just to see if you're doing well today, but if you're taking advantage of trends that will continue in the future, then that will be a big plus. And if you can pivot to that place, then do so. If you cannot pivot to it, you have to think about how else you can be a part of that coronavirus economy where your content and engagement is online, you're hands off, you're doing it remotely, you're using technology to replace physical events. And so that's something that's going to be there. And the key, as always, to fundraising is raise when you have a growth story. Whenever you go out to an investor, you should always be talking about what the customer said or did, what the team is doing, what products you're building, and you want to demonstrate you have a growth story. If you just come in with a forecast, that will convince nobody. You have to come in with evidence that you're actually doing it today and the story is in progress. And that's what investors are looking for with the updates, and your story is to see if things are really moving forward. So next question up is, what role do we see for ourselves playing at this time? Has it changed? And for the most part, it's the same. We're still helping companies connect for funding. We're helping investors learn about funding and how to be successful at it. So that part stays the same. The one change I see coming up is about half our companies are well positioned for the COVID-19 world and are doing very, very well with it, and the other half are not. And what we end up doing is going to the ones that are not and coaching on how do you pivot into a place to take advantage of the COVID-19. And of course, we're not just looking at the pandemic, we're looking at the underlying trends that it accelerates. It accelerates healthcare, telehealth and remote work and distance learning. There will be different things such as cybersecurity that will accelerate as far as the need for it in this, because there'll be new opportunities for COVID-19 threats that come in, scammers and so forth. But fundamentally, everything that people are doing today was already in motion and in place, and is just accelerating. And after the COVID-19, I believe that it in some ways will go back to a normal life, but in other ways we'll find that the old way was not as efficient as the new way. And you'll see more things stay online. You'll see less travel. You'll see fewer meetings. You'll see fewer physical meetings. And you'll see people moving into a mode where they're making use of these online tools. And so as good entrepreneurs and good startup CEOs, we should be looking at that and taking that lesson to heart and start to position ourselves to take advantage of that going forward. So there's that aspect of the COVID-19 that we do help startups with, and coaching them on how to do that in the CPG, the healthcare, and the tech space is mostly where we're spending our time. And we see a lot of that at the CPG level. For example, we see companies that make shelf-stable products are, doing better than those that make perishables. We're seeing companies that are having to wait because the stores are taking longer to do reset of shelves. And at this stage, they're running around just trying to keep stock on the shelf. But for the most part, they're not able to bring new products in as much as they were before. And then you'll see people working on the supply chain, where I think we'll see more and more people ordering for delivery to the home and bypassing the grocery. And you'll see that supply chain shift around because they're finding it's so much more efficient if somebody can bring it to you rather than you having to go to the store to pick it up. And I see that shift accelerating from this COVID-19 world itself. Those are the questions that have been presented so far. What other questions do you guys have at this point? So the next question is, you mentioned Zoom and Slack earlier. Are there specific companies that you're bullish about long-term? Companies like Intel, Microsoft, Apple, Citrix, Zoom, Slack, etc. And I think remote work is going to be a big one, and we're already seeing that priced into Zoom and Slack stock prices, and companies that make tools that enable that will do well also. There's a lot of tools out there that we deal with online that are just very nascent beginning tools. They could be much more sophisticated for online collaboration, for sharing information. Google Drive is great, but is pretty bare bones at this point. I could see people building on top of that as well. I see a lot of groups coming in with new tools in the distance learning, where it's not just a Zoom tool, but it's actually courseware and content management. One of the biggest challenges I see companies out there facing with remote workers is, yes, they're supposed to be working on this, but are they really working on this? So work productivity tools, work monitoring tools to see, are you online and are you focused on the project we're supposed to be focused on, and can we see that through the tool set? So I see a lot of interest from companies on that, because now you have to manage in a different way. You can't walk around the office and look to see who's doing what. You now have to have tools that look around for you online to see what people are doing and where they're going and what they're doing. And so I think we'll see more tools in that direction come out that will see a renewed life here as well. You also see healthcare tools like ventilators and distance learning tools, where they're going to have to rethink the hospital. Having everybody come to a centralized place, I think, will go away. And what we'll have to do is have people stay where they live or where they work, and then use personal monitoring devices like the iWatches or the Apple Watches. We'll see people doing remote monitoring tools using different techniques. We'll also see people not having to come in for visit to the doctor, but using the remote telehealth tools to talk to the doctor, but you get to stay in place and you don't have to drive everywhere. And so I see tools like that coming up also as being a good thing to look at. Any other questions at this point? So I think we're getting near the end of our half-hour time slot. If you have other questions, go ahead and post them, and we will answer them here. But if I don't see more questions, I think we'll go ahead and close it here at the half-hour mark, as I think this is what most people had expected for. This is about as many questions as we have, so I think it's a good time to break. But if you have questions, we have one more minute for you. Just go and post them in there. If we don't make this time slot, you think of a question later, just email me and I'll be glad to give you a thoughtful response through email directly. And as always, we'd love to catch up with you guys individually afterwards to talk about what you're doing there. So just to wrap up, 10 Capital helps startups and investors connect for funding. We're not a broker. We're not charging back-end fees. We just charge a monthly retainer, and that's to the companies and some investors. We go through the process of helping companies get their documents ready, get their campaign ready, and then engage those investors. So it's really for companies that are looking to get access to more investors is what we do, and in helping investors find the startups that they want to invest in. So if you have any further questions, feel free to email me, and if there are no other questions now, we'll go ahead and close it out. Is there anything else? Well, I want to thank you guys for joining us today and looking forward to seeing you back soon. Appreciate your taking time, and thanks so much for joining us today. And with that, we'll go and close it out. Good group of questions you guys have there, and appreciate your taking time.